Welcome back to the deep dive. We spend so much time talking about the front end of healthcare innovation, the new drugs, the fancy startups, but we almost never talk about the plumbing.
Which is funny because without that plumbing, none of it actually gets to a patient.
Exactly. And today we are looking at maybe the biggest, most important piece of that plumbing in the entire U.S. system. We're talking about Cardinal Health. And if you think this is just some boring chat about warehouses and trucks, you are in for a surprise.
Yeah, the Q2 2026 earnings report they just dropped is, well, it's kind of a revelation. It really challenges the whole idea of what a logistics company even is anymore.
Let's just start with the scale because
It's per.
it's mind-boggling. I was reading the report, and the main number, the revenue, maybe do a double take, $65.6 billion.
So it's a staggering number.
That's with a B, and that's for one quarter. It's a 19% jump over last year. I mean, how does a company that big grow that fast? It's like tech startup growth.
It is impressive. But, and I always say this, revenue is vanity. The real story here, and kind of the mission for us today, is to look past that $65 billion. We need to figure out how Cardinal is pivoting from just, moving boxes to driving high-tech healthcare.
Right, because moving a box of aspirin is one thing. Delivering a radioactive cancer treatment that expires in a few hours, a whole different ballgame.
Precisely. And that's the pivot Wall Street is finally starting to see.
Okay, so let's get into the scorecard.
Yeah.
The report came out February 5th. You mentioned the revenue beat. They topped expectations by almost $750 million?
Yep. But the bottom line is where the story really gets interesting. Their non-GAAP earnings per share, so basically their profit per share, came in at $2.63.
And the analysts were expecting what?
They were looking for about $2.31.
So they beat by 32 cents. That's huge.
It's a blowout in this industry. That's a 36% increase in earnings year over year. So just think about that for a second. Revenue is up 19%.
But profit is up 36%.
Exactly.
Okay, let's unpack that. I love it when the math doesn't match in a good way. If profit is growing almost twice as fast as revenue, that just means they're getting way more efficient, right?
It's the holy grail of business. It's what we call positive operating leverage. It means their gross margin is growing a lot faster than their SG&A, their overhead, their administrative costs.
So more money coming in, but it's costing them proportionally less to make it happen.
You got it. And because of that, management did something investors love. They raised their full-year guidance. They're telling the market they expect to earn between $10.15 and $10.35 per share for the full year.
Raising guidance halfway through the year is, well, that's a serious flex. It tells the market this wasn't just a lucky quarter.
And the stock reacted. It hit a 52-week high, closed around 227. But to really understand this, we have to pull apart the business segments. It's not just one company. It's like 5 engines running at once.
Let's start with the big one, the pharmaceutical and specialty solutions segment.
The heavy lifter.
This one part of the business did $60.7 billion. So almost everything, up 19%. But the report kept using this word, specialty. They're expecting specialty revenues to pass $50 billion this year.
Okay, this is the most important definition for our whole conversation. Pharma is the old model, moving pallets of generics, Tylenol, to the big pharmacies. It's a volume game, and the margins are razor thin.
Okay.
Specialty is different. This is biologics. This is oncology drugs for chemo, complex treatments for urology. These drugs can cost thousands of dollars for one dose. They often need cold chain logistics.
Meaning they have to be kept cold the whole time. So the complexity, the moat is just, it's wider. You can't just start doing this tomorrow.
Exactly. And the margins are much better. But here's where it gets really smart. Cardinal isn't just delivering the drugs anymore. They're buying the places that prescribe them.
You're talking about the Solaris Health deal.
Yes. They closed that acquisition in November. Solaris is what's called an MSO, a management services organization, specifically for urology practices.
Okay, so help me with the strategy here. Cardinal's a distributor. Why are they buying a company that manages doctors' offices?
Because they want to be sticky.
Yeah.
If you're just dropping off boxes, a hospital can switch to a cheaper vendor tomorrow. But an MSO, they run the back office, the billing, the tech, and this is key, the inventory management for those doctors.
I see. So Cardinal becomes the operating system for that whole urology practice.
Correct. By owning Solaris, they aren't just a supplier. They're embedded in the doctor's entire workflow. It's vertical integration. It locks in all that volume for those really high-value prostate cancer drugs.
Turns the transaction into a partnership. That's smart.
It's incredibly smart, and it connects perfectly to the other huge driver in this segment, GLP-1s.
The weight loss drugs. Ozempic, Wegovy. Can't avoid them.
You really can't. And management said they accounted for about 6 percentage points of that revenue growth. That is a huge slice from just one class of drugs.
But I did notice in the transcript the executives sounded a little cautious about it. They talked about a shift from injectables to pills.
This is a really subtle but important point. Right now, these are all shots. They're cold chain, they're bulky. The future is oral versions. Pills.
And pills are usually cheaper, aren't they? So would that mean less revenue?
The revenue growth might flatten out, yeah. But management said something very specific. They expect oral options to be efficient to distribute.
Ah. It costs less to ship a bottle of pills than a big refrigerated box of injectables.
Exactly. So even if the top-line growth from these drugs slows down, the margin, the actual profit they make, could hold up or even get better because it's just simpler. They aren't betting on the gold rush lasting forever.
That shows discipline. Okay, before we move on, what about Red Oak? It sounds like a secret society or something.
It's a little less exciting, but very profitable. It's their joint venture with CVS Health for buying generic drugs. Basically, a giant buying club to get better prices.
And the report said, consistent market dynamics.
Which is code for, it's a cash cow. It's the engine room that's funding all the other cool stuff we're about to get into.
Okay, let's talk about the comeback story. GMPD, Global Medical Products and Distribution.
The MedSurg side. Bandages, gloves, all the stuff that isn't a drug.
The numbers here felt like a magic trick. Revenue was basically flat up only 3% to $3.3 billion. But profit shot up 106%.
Incredible leverage.
How in the world do you double your profit when you're not really selling more stuff?
You stop losing money. For the last couple of years, this segment was a total mess. Inflation, supply chain problems, so they launched this GMPD improvement plan.
Which sounds like a nice way of saying they cut costs like crazy.
They did. They simplified operations, renegotiated contracts. They just tightened all the screws on that part of the business.
So it's an efficiency story, but was it only about cutting? Or are they actually making better products too?
No, there's innovation too. They specifically highlighted a win with their SmartFlow device.
Right, I saw that. It's a pneumatic compression device.
Total mouthful, I know.
It's basically those inflatable sleeves they put on your legs in the hospital to stop blood clots.
Exactly. And it's a huge problem. Cardinal launched a new version of these, and they said it crushed its launch expectations.
That's important because it shows they're not just a low-cost distributor. They have some R&D chops.
True. But, and here's my expert buzzkill moment, we do have to mention the caveats. Management was clear that about 3 to 4% of that growth came from inventory timing.
In plain English, what's that?
It just means some customers, like other distributors, bought more stuff this quarter than usual, maybe to get ahead of price hikes. It pulled sales from the next quarter into this one.
So some of that profit doubling was a bit of a one-time sugar high.
Right. They warned it'll normalize, so don't expect another 100% jump next quarter, but the overall turnaround is still very real.
Okay, let's get to what I think is the most exciting part, even though it has the most boring name imaginable. The other segment.
It's a terrible name for what's basically the growth engine of the whole company.
I mean, this segment grew revenue 34% and profit 52%. This is nuclear, at home, and OptiFreight. Let's start with nuclear, because I don't think nuclear physics when I think Cardinal Health.
You should. This is maybe their strongest moat. The key word you need to know is theranostics.
Theranostics. Okay, break that down.
It's a combination of therapeutics and diagnostics. So imagine you inject a patient with a radioactive isotope that's designed to stick only to cancer cells. You use a PT scan to see exactly where the cancer is. That's the diagnostic part.
Okay, got it.
Then you use a similar molecule, but this time it's armed with a different isotope that actually kills the cells it attaches to. It seeks out the cancer and irradiates it from the inside out. It's like search and destroy.
That is science fiction. But why is a logistics company winning here?
Physics. Specifically half-life. These drugs decay so fast. Some lose half their power in just a few hours. You can't make them in a factory overseas and ship them. You can't even store them.
You have to make it and use it, like, right away.
Right. So you need a network of specialized nuclear pharmacies all over the country. So you're never more than a couple hours away from any hospital. Cardinal has that network. It's incredibly expensive and regulated.
So if I'm a biotech company with a new nuclear drug, I basically have to partner with them.
That's it, which is why they have over 70 of these products in their pipeline. And now, connect the dots back to the Solaris acquisition.
Urology.
A huge number of these new drugs are for prostate cancer. Who treats that? Urologists. Who manages the urologists? Solaris.
It's a completely closed loop. They control the doctor, the drug, and the delivery.
Wow. It's a powerful ecosystem, and customers seem to like it. They talked about having a net promoter score way above the industry average for that business.
Okay, then there's at-home solutions. We know everything is moving to the home. What are they doing there?
They're doubling down. They bought a company called Advanced Diabetes Supply, ADS, and that's going well. But they also launched a new thing called Continue Care Pathway.
What's that?
It's a program to help local pharmacies manage diabetes supplies for their patients. It's all about making sure people stay on their treatment, have their test strips, their monitors. It creates a recurring customer.
And they announced a big new partner there, didn't they?
Yes, with public supermarkets.
That's huge in the Southeast.
Exactly. It hooks their home health logistics into a massive, trusted consumer brand. It's another revenue stream that completely bypasses the traditional hospital.
And finally, in this other bucket, there's OptiFreight. Revenue up over 30%. Is this just their shipping department?
It's shipping with a brain. It's logistics as a service. Hospitals have no idea how much money they waste on shipping.
It's just a black hole in the budget.
So OptiFreight comes in with a tech platform. Total View Insights. It's a dashboard that shows a hospital CFO exactly where the waste is. Like, why did you overnight this for $50 when it wasn't needed for 3 days?
So they're not just selling shipping, they're selling data and efficiency.
Precisely. And in this environment, a tool that saves a hospital money is an incredibly easy sell.
So let's zoom out. The core pharma business is a cash machine. The medical business is fixed. And these new growth engines are on fire. That must generate a ton of cash.
Which brings us to following the money. Year to date, they've generated $1.8 billion in adjusted free cash flow.
That is a lot of dry powder. What are they doing with it?
They're being very shareholder-friendly. They spent $750 million buying back their own stock. They actually hit their full-year buyback target early.
Which usually means management thinks their own stock is cheap, right? Even at an all-time high.
It signals a huge amount of confidence, but they're also being responsible. They got their debt leverage back down into their target range of 3.2.
So the balance sheet's in good shape. They have cash. And the CFO mentioned they're looking for opportunistic M&A.
And that word opportunistic is really important. It means they aren't desperate. They're not going to do some massive distracting merger. They want tuck-in deals.
Like Solaris.
Exactly. Things that just bolt right onto the machine they've already built. Maybe another MSO in a different specialty. Maybe more home health tech. They have the money, but they're being disciplined.
It sounds like a very grown-up strategy.
It's the strategy of a company that knows exactly what it's good at and is just buying things that make it even better at its core mission.
So to wrap this all up, we started by calling Cardinal the backbone of healthcare. But after all this, backbone feels too passive. A backbone just supports things.
I agree. I think a better metaphor now might be the central nervous system.
Ooh, I like that. Explain.
A backbone is just structure. A nervous system transmits data. It coordinates action. With OptiFreight, they're the data layer. With Solaris, they're the management layer. With nuclear, they're delivering the most advanced science to the point of care.
They're becoming a partner in actually delivering the care, not just the stuff.
That's the pivot. They are embedding themselves so deeply into the clinical workflow that they become almost impossible to replace.
Which brings us to the big question for anyone looking at this company. Is Cardinal Health transforming from a low-margin logistics business into a specialized healthcare tech company?
That is the multi-billion-dollar question, isn't it? And with the stock at these highs, it seems like the market is starting to believe it. They're valuing that $50 billion in specialty revenue very differently than the old business.
But there are risks. We talked about the GLP-1 boom maybe leveling off. What about government drug pricing?
Regulatory risk is always the big one. And they have to prove the turnaround in the medical segment is for real. But for now, the diversity of the business is its strength. If one area slows down, another one, like nuclear, speeds up.
It's really a hedged bet on the simple fact that people will continue to need healthcare in America.
As long as people get sick and need complex treatments, Cardinal finds a way to get paid. And looking at the demographics, that demand isn't going away.
It's a pretty fascinating look at the boring back end of an industry. We always focus on the flashy stuff, but the real revolution might be in the supply chain itself.
The plumbing is where the profit is, especially when the pipes get smart.
When the pipes get smart. Love that. We'll leave it right there. A huge quarter for Cardinal Health and a really interesting look at the future of healthcare logistics. Thanks for breaking it all down.
My pleasure.
And thank you for listening. We'll catch you on the next deep dive.